Let's talk money.
Tax tension, mutual fund mess, confused about buying property, or maybe just trying to save up for that holiday? Well, you have reached the right spot because this is where all of your money questions and confusions will get cleared up. Welcome to CNBC-TV18's brand new offering, a show that will make money matters simple and straightforward. I'm your host, Surabhi Upadhyay. Get ready. Let's talk money. Yes, you got that right. This is our new personal finance show. And joining me to talk money on episode 1 are Mohit Gang and Harshvardhan Rungta. Gentlemen, let's have you here on the table, bring you in. It's a special day because we're launching this brand new initiative. And you've been no strangers to either personal finance or CNBC-TV18. We've spent many years discussing all of these important things, but it's fabulous to have you here today.
Thank you so much, Surabhi. Always a pleasure to be talking money with you.
Welcome to the show to you as well, Harsh.
Thank you, Surabhi. It's been a while that we've been talking personal finance.
Yes. So, we thought what's different and why this show, because we really want to reach out to the viewer, whoever they are, wherever they are watching us on television or on digital platforms, and try and make things very, very simple. So we'll try and keep it very interactive. We will have more engagement. And of course, we've been telling our viewers to reach out to us with questions, and we've got the experts in the house. So what you ask, they will answer. Before I get started with the questions and the queries, I just want some perspective from you, gentlemen, because you talk to clients across the board and you're seeing markets are getting more complex. People are getting more restless. The markets have been quite benign, at least the equity markets, right, last couple of days. But Mohit, just some reflections, thoughts, when you talk to clients, when you hear conversations on wealth management, personal finance, what is new and what remains the same?
Look, I think the amount of impatience which I'm seeing in the market is a new to me, honestly. I haven't seen this kind of, and benign is the right word. I've never seen kinder markets than these, where perhaps everything which you're turning is turning to gold for last couple of years. But honestly, those golden stories don't last for long, and which is what we've been trying to convince our clients. However, it's easier said than done. As long as it lasts, I think it's a party going out there.
Absolutely. And why not enjoy the party? No harm in some parties here and there. Harsh, your thoughts?
So, well, Surabhi, what concerns me is that, there are people who believe that this kind of returns that they've made in the last 1 year or probably 2 years will continue to, generate the same kind of returns in the future. And their expectations is going to probably what's going to disappoint them in the future. Markets will do what they have to do.
Yeah.
It's about how you behave in the market. So I think that's what the narrative should be, is to how do you deal with a volatile product, like an equity investment, for that example, and especially if you've had a very good experience in the last 1 or 2 years.
All right, so let's get started. We have questions already coming in from our viewers. And here's the first one. I think we've got Mr. Gunashekar joining in. And guess what? He's joining in all the way from Saudi Arabia. So the word is really spreading. Mr. Gunashekar, thank you so much for being with us. Welcome to the first episode of Let's Talk Money. Tell us, how can we help you?
I am a railway engineer from India, and currently I'm working in Saudi Arabia. I have a corpus of 50 lakhs to invest in mutual funds or PMS. I have saved money of 50 lakhs. I want to invest in equities. I have few questions to clarify from CNBC Wealth. The first question is, the market is almost very close to high points, 21,800 plus. Is it a good time to invest the lump sum money in the market? First question. Second question is, which is better one, either mutual fund or PMS, portfolio management services, which will be better one? I'm expecting a return of minimum 15%, and I have a patience to hold my investments for a period of 5 years. So can you suggest me what type of investment will be better?
Mr. Gunashekar, 15% return every year. You're putting up a stiff target for our experts to meet over here. But okay, just to take down the other points, you have 50 lakhs to invest. And the good thing is you have a long holding period. I think you don't need the money for the next 5 years. And PMS or mutual funds, that's the real question here. Sir, just to get some more perspective so that our experts can give you a holistic solution, can you give us some more idea about the kind of investments that you have? I mean, just the asset allocation. Apart from this 50 lakhs, do you already have money invested in equity? What about fixed income? Just some more idea about your investments.
Yes. I have a corpus for my son's education. I have holding some money for my further studies. Even he want to go to abroad, I have some corpus for the further studies, higher studies. So I don't
Okay.
need 100%. I don't need this money for 5 years minimum.
Okay, that's a good place to be. And I mean, 100%, you know you don't need 50 lakhs for the next 5 years. It's all for equity investing. So hang on, let me toss this to our guests. So I mean, it's a great position to be in. I think we should all aspire to be in that situation, right, by the time that we reach his age. But I want to take both of your thoughts one by one. Mohit, what would you tell him?
Look, I think on his first question, which is whether he should go ahead and invest in the market at these levels. Look, honestly, my answer is he's a little too late. He should have invested it yesterday, but today is the second best day. Right? I have no two doubts in my mind, and I've been consistently repeating that at number of forums that the cost of staying out of this market is much higher than cost of staying in and facing a correction, if any. 43 years of market history, there's not been a single year when you have not had a 10% or more correction. So you should very well anticipate that. You should be ready and prepared for that, but doesn't mean that you stay on the sidelines.
You have to wait for it and try and time for that 10% low.
Absolutely not. You have to be in the middle playing the match yourself. You can't be on the sidelines watching other players play it, right?
Okay.
So I think that's very clear. On the second part, whether a PMS or a mutual fund, look, honestly, I think the debate is eternal. My sense is first you should have your other corpuses and other investments completely done up, which is your emergency corpuses, your debt investments, your safety nets and other things on terms of asset allocation, and then your equity mutual funds. To me, that comes in the ladder much before you kind of elevate yourself and go into direct stocks or PMS. Okay. So if your mutual fund has been done, your allocations are all to the T and it's working perfectly well, and this is an additional extra pot of money which you really want to take extra chances with and put it and deploy it for high risk, high return, volatile conditions you are okay with and all those kind of things, then yes, by all means go ahead and take a PMS. But my sense is I would first go mutual funds, do my asset allocation right, and then go up the ladder and then try and
then look at PMS.
Yes.
Okay, Harsh, come in on this, and then his expectation, right? I think maybe he's also considering PMS because he wants 15% a year, you know, on a CAGR basis. And threshold is 50 lakhs, so I mean he's meeting the threshold for PMS. What would you, if you were in his position, would you look at the PMS route?
No, so I have a bias against PMS, quite honestly.
Okay.
So I believe that mutual funds can, in that context, offer you everything that an investor would need. I mean, you're looking at a higher risk, say probably. So why a PMS? Why do you want a more concentrated portfolio? Probably customized.
Better returns, maybe,
Anticipation of better returns. I mean, let me put it that way. See, the idea is that if you look at it, one is from the returns element, the other is from the construct point of view. So mutual funds are far better regulated. I mean, they're more transparent. In terms of costs, it's much more efficient. In terms of tax efficiencies. So because these are also nuggets for your investments, you don't only look at returns. You have to look at many other things when you're investing your money. So I believe as a package, in terms of the returns potential, in terms of the cost elements, in terms of tax efficiency, in terms of regulation, in terms of transparency, mutual funds will kind of offer you everything that an investor would need. Okay. So why not explore and just get the best out of that first? And as Mohit said, I mean, PMS would come probably one leg later, not for a profile like this gentleman.
Okay.
I would say it would be a little different profile where you have done enough in mutual fund and you believe that I can't do anything more, I can't get more out of this. And then you have some extra money where you want to take some risk in addition.
And 15%?
Oh, okay. So now, if you look at historics, if you look at some numbers and we try and come to a point where we're trying to estimate as to what kind of returns can I expect, okay?
From your mutual fund portfolio.
From equities, mutual funds, or any, so it's more like predicting, rainfall. Say, for example, every year we know, times in memorial that, monsoons will be around June onwards kind of thing. Now, it could get delayed, it could get preponed, whatever. That's a different thing. But on an average, you'll know exactly when it's going to rain, right? So is the case with the markets. I mean, if you take historic data, though it has no indication of future, but it gives you a sense as to what returns on an average or a range that you can expect. Yeah. So there have been some studies which say that if you've been invested in market for a minimum of 8 years and beyond, the returns that you can expect is between 12 to 15%.
Which is what he's really seeking. So perhaps he's not off the mark, absolutely.
Yeah.
No, not at all.
Okay. So Mr. Gunashekhar, hopefully that answers your question. Our experts here feel that you need to stick to mutual funds, get a good portfolio going, perhaps consult a financial advisor as well to create a proper sort of portfolio, a bouquet of funds that could make you reach your goals and objectives. We have another viewer with us now, Nikhil Ranglani. So let's see what his question is. Hi, Nikhil.
I'm an entrepreneur aged 28, residing in Mumbai. So
Okay.
I've been trading in markets for last 4 to 5 years now.
Okay.
So being into market, I know when the market is in oversold or overbought zone and everything about all the technicals and all that. So my question was like, I have a fixed set of money that I invest in mutual funds every month from my all family members' accounts. So what I
Hmm.
generally do is when the market is at the bottom, like the last investment that I did into mutual funds was when the Nifty was at 18,800. At that point
Okay.
of time, I through the technicals, I knew that this is going to bounce from here. So I put
Okay.
in a lump sum amount of 6 months into the mutual funds at that point of time. So this is what
Hmm.
I usually do. So whenever the market is at the bottom, I add my funds into the mutual funds. And when the market is in momentum, for what we are seeing in the last 1 year, the entire momentum that we have seen, I generally trade into the markets. And whatever
Hmm.
the earnings that I get through my trading, I add it into my SIP amount. Let's say, for example, if 20,000 is the SIP amount, so in a year it becomes 240. But if I've earned 60,000 or 1 lakh more in an entire year, I add that amount into my SIP amount itself. So
Hmm.
since last 6 months, I have not got an opportunity to invest into mutual funds, and also the trading gains are too high. So for that reason, I wanted to ask that is there any chance or scope by March end, will we get any like chance to invest into mutual funds, or will we see a bottom before March? Or do I have to just shut my investment in mutual funds and just keep waiting till the market goes back to a normal stage?
Nikhil, I really think that, we need to be special wizards to know where is the bottom and when can you exactly time and put in that next SIP. I know, Nikhil, you're, of course, tracking technicals and trying to predict that bottom. But before we get to the response, let me ask you one more thing. What is your, again, overall asset allocation? You're saying that you're trying to put these trading gains back into mutual funds. All into equity? Do you also have fixed income exposure? Just tell us a little more about it.
So I have a 25%. I have 4 mutual funds in each and every member's account. That is 25% to small cap, 25 to mid cap, 25 flexi cap, and 25 large caps. So that is how I've allocated my entire mutual fund portfolio. And in terms of my mom's and my wife's accounts, I have some SGBs as well. So 10% or 15% of their portfolio has SGBs, and 60% of their portfolios has equity.
Interesting. SGBs, sovereign gold bonds. You've got equity and you've got a bit of gold. Hang in there. It's a really interesting question, and it tells us about how people invest. Now, he's taken a bit of a one-size-fits-all kind of an approach, just done the plain basic math for all family members, and he's going about allocating, trying to trade in the market, plow those gains back into mutual funds. What do you think?
Look, honestly, I think there is a basic dichotomy in the way Nikhil has kind of structured his overall allocations and his investment theorem, right? I would perhaps try and do it in a slightly different way, and there can be many arguments for and against it. What I would do is, technically, we would keep a strategic portfolio, which could be 80% of your money, 70% of your money, 60% of your money, and that each one can decide for his own. And then we will have a tactical portfolio, right? So strategic is more long-term, structural in nature, which is perhaps generational wealth, which you want to create, or retirement wealth, which you want to create. And tactical is your play money, or rather, I'd call it a casino money, right? So and both the pots have absolutely no linkage to each other. I would rather prefer that the two bank accounts are completely separate and demarcated. Whatever you make in your tactical pot, just keep aside. If you're great at it and the tactical pot is increasing, my best wishes. You continue doing that and you continue growing that pot for yourself. But don't touch and dabble your strategic pot at all. So your SIPs, your regular investments in mutual funds, your asset allocation has to be as it is, and that has to keep growing irrespective of the market level. It can't happen that you invested 18,800 and then you're sitting at 22,000 wondering whether I'll get an opportunity to invest more. That absolutely cannot happen, Surbhi. If you lose the best 10 days of the market, if you're not invested, data tells that you lose almost 40% of your returns, right? So it's absolutely a no-brainer. You have to keep the two pots aside, very, very demarcated. Just play tactical. Yes, by all means, if you're great at trading, try that and let your tactical pot grow and let it be bigger than the strategic pot.
But he's, while I completely get what you're saying, I think what he's also trying to do is that from that tactical portion of the portfolio, whatever trading gains are there, he's trying to put that back into funds for longer term wealth creation. So Harsh, come in on this two-part question. One, this whole piece on timing, and I know you've given your point of view on this before. So if you're getting a trading gain, then why not invest it the same day or maybe the next day or whatever? Just your thoughts on that. And also the approach of having very similar portfolios for all family members. I mean, we haven't spoken to him enough, but this whole thought of people's differentiated goals, risk profiles, where you are in your life, I'm not sure if that has been taken into account here.
So, well, Surbhi, we've been into stock market all our lives. I'm a third generation stockbroker. So my family has been into stockbroking. I can say this with enough confidence to say that traders don't make money. You may be lucky probably 9 times out of 10 where you believe that you've bought something, sold something, you traded and you made money. The 10th time is most likely that you lose all that money. So, my philosophy is very simple. I mean, when you can do nothing and make money, why do you unnecessarily keep, swinging your arms here and there? Because stock market, if you're investing, okay, I'm using the word and emphasizing on the word called investing. Okay, when you can invest into good companies and just sit and do nothing and make money, why would you engage yourself so much and just keep trying to time the market? So, quite honestly, I cannot predict the market.
Coming from a family of stockbrokers, huh?
And I'm also telling you that I don't know where the market would be in March 24. Because that was Nikhil's question, asking them, where do you think markets will be? I honestly do not know. And I'm reasonably sure that all the seasoned fund managers who spend their lifetime in stock market would not be able to correctly predict where the markets would be in 2024. So my suggestion is very simple. I mean, he's obviously occupied in something else on a professional basis. I mean, on a day-to-day living basis, he's doing something else. Why make trading your occupation? I mean, that's not really required, right? Focus on your work. That will get you more money than what trading will eventually. Let your investment portfolio do, on its own. I mean, it can certainly grow on its own.
Fair point. See, I think, for viewers, I just have to say, you might be getting a lot of boring advice on this show, but sometimes boring is the best way to make money. On that note, we're going to take a very quick break. Back with some more questions and more answers on the other side.
Let's talk money.
Welcome back. You're with us, and we are talking money. The show is called Let's Talk Money, and our experts Mohit Gang and Harshvardhan Rungta are with us. Let's quickly get to the next question on the show. This one's coming in from our viewer Naveen Kumar. Hi, Naveen. How can we help?
Thank you for taking my query. My question is that we all know nowadays that the best way to get oneself adequately covered by insurance is term insurance. But when we try and get term insurance, the insurance companies aren't very keen to really sell this product because they have other things in mind. And sometimes because of various reasons like medical issues or income statement issues, you may not end up getting term insurance, and hence you don't have the option of getting adequate insurance cover. So in such cases, then what do we do? What does the person do? Does he get some other kind of insurance where at least he gets some insurance cover, or he forgoes and forgets about insurance and then depends on savings to keep his sort of corpus ready for medical treatment? So what is the advice from the expert?
Naveen, very important question, really important. I'm glad you brought this up. Just a clarification, is this insurance cover, is this something you're seeking for yourself, someone else in the family, just so that we know the age profile of the person as well?
My wife went for medical insurance, for term insurance, and on medical ground, it was sort of refused by the underwriter. So now for her, there's no term insurance. So what does she do? Like, does she have some other means of getting insured, or she settles for a lesser amount of insurance, or she forgets about it and just goes about without insurance? Are there any options available in such cases wherein you can't get term insurance when you want it? That's my query. What are the options?
Harsh, take up this, because I know you look at insurance in a lot of detail. Term insurance, you're getting rejected by the company. What do you do?
Yep. Naveen is right when he says that term insurance is probably the best way of getting an adequate life cover. Now, for several reasons, of course, for income criteria or health conditions, you may be denied an insurance cover. So, which is fair. I don't think there's anything to complain on that count. If there is a health issue, then you will not get a term insurance, or if you don't have income. Now, the closest that comes to this is disability insurance. One in the form of a personal accident policy, which is a disability due to accident, death or disability due to accident, or you have a critical illness cover, which is basically disability due to illness. So this comes closest. Now, in terms of eligibility criteria, if you're taking a personal accident policy, which is a disability insurance for accident, income is going to be considered. So you will need to establish that you have an income. which is likely to be lost in case of disability. And health condition is not that much of a concern. It's more the
But
occupation
you
side.
get the payout only in the unfortunate event of the accident. It's
That's
not
correct.
it's not a life cover. But if there is a critical, or if there's a major accident, then the cover, then the sum assured gets paid
Correct.
out.
So it pays out in case of accidental death as well.
Accidental death.
So death and disability.
Okay.
Okay. Unlike a term insurance which pays out in any
Only death.
situation. So if you're not getting a term plan, at least cover yourself for an accident-related death or disability.
Or disability.
And in case of a critical illness, which is because of an illness you're rendered disabled, so in that the medical condition is going to be important. So if you have some pre-existing medical condition, you might not get this cover as well. So income is not a criteria here. Health condition is a criteria. In a personal accident, income is important. Is going to be considered. Health condition may not be considered.
May not be. So, I mean, nothing is perfect. Nothing is as good as getting a term plan. But at least there are some options. Mohit, anything to add?
Just a quick one, and perhaps this might work. There are some credit cards which gives you Suraksha Shield, which is that if you subscribe for that card, they will have a group insurance, right? So you will have to try some mechanism where you get coverage under a group insurance. And in offices we see, right? So irrespective of your pre-existing illnesses or your diseases, you get a group cover if you're working in a corporate company, right? Similarly, on credit cards, previously mutual funds used to have a product, but now these days SEBI has stopped that product. But some credit cards still give you Suraksha Shield. You might just want to go for those and get that group insurance cover done via
Check that
that
out
route.
as
It's a roundabout way, but yeah, it works.
Naveen, hopefully that's helpful to an extent, and maybe you can find some options at least for your wife. Gentlemen, we are at the end of the show, almost out of time, but this show will always have a money minute as we sign out. Some gyan, some tips, some PF advice that our viewers can take back with them. So very quickly, your money minute.
My quick one is for next week. Effective 12th of Feb, you have a new tranche of sovereign gold bond opening up. I firmly believe that gold as part of an asset allocation is a must do. It's always been as part of our asset allocation in our families with our parents and everyone, but SGB is a must have product. Everyone should have at least 10% allocation to commodities in form of gold. You get a 8-year lock-in, but you have a tax-free return from gold investments, and over and above that, you get 2.5% interest paid by Government of India to you every year. Nothing can beat that.
Remember, our viewer Nikhil already has SGBs in his portfolio, right? So he's on the right path. Money minute.
Okay, so Surabhi, if I can be brutally honest, I mean, I don't mean to demean or doubt any equity investors' capabilities. But off lately, we've been meeting a lot of those investors who've been saying that I entered the market in the last 6 months. I've entered during COVID. And and obviously, so markets are done so well that you kind of are having a good experience with your investments and you're generating profits. Now, let that not confuse you to believe that you're great at trading or you're meant for trading. Okay, this will possibly confuse a person, and just because you're doing well, you believe that it is because of you. Well, I would say it's the horse riding you. You're not riding the horse. Okay, the markets, if any person blindfolded would have picked up any stock in the last 6 months or 1 year, would have done well. So it's not essentially or necessarily your capabilities. So don't confuse what markets are doing to your capabilities and over allocate to equities, because I've seen and I'm noticing this, that many investors are now going overboard with allocations to equities, primarily because believing that they have driven the market, which is not true.
So don't over allocate to equity and don't think you're a stock market genius. I guess that's the advice. Gentlemen, thank you so much. Fabulous having you on the inaugural episode of Let's Talk Money, and we hope that this is the start of many, many conversations to come.
Absolutely. Thank you so much.
All right, viewers, thank you so much for joining in as well. Remember, keep writing in. This is your show. It's of the people, by the people, for the people. So write in. Our email ID is askcnbc-TV18@nw18.com. All your personal finance questions. We'll see you again next week.
Let's talk money